Hello, my friends. Brett Pattison coming at you from the financial capital of the West, Salt Lake City, joined by the chairman.
How you doing, Brett?
Oh, Brian, you know what? That's an interesting question right now.
Are you living the dream?
I was, yeah, well, let's talk about that. Let's talk about that because in fact, the last few podcasts we've talked about, are we in a recession or aren't we? Are we or aren't we?
Mm-hmm.
We've talked about being in a bear market. We've talked about the psychology of losing money versus making money. And we've talked about a whole lot of stuff there. Today we're going to take a history lesson. And we're going to look at three periods in time that are very similar to what we're dealing with now. Although there's no perfect scenario, right? 1974, 1975, 1980, and 90 and 91. And what those periods have in common with today is that there was high inflation. They were periods of rising interest rates. In fact, the Fed just yesterday raised the Fed funds another 75 basis points. And, of course, they're bear markets.
Mm-hmm.
And each one of those also, going back to a podcast, are we in a recession or not? They were recessions. Just saying.
Mm-hmm.
I'm kidding. All right, so right now, as it stands, just a quick market update. S&P down 22, almost 23% on the year. NASDAQ down 31%. And so that gives you some context as to where we are right now in this bear market. All right, let's go back in time now, Brian, and let's look at when this has happened before and hopefully what past history can teach us about what to do now.
Okay.
1974. That was before I was born, by the way. Not that that matters.
Not me. I was 10 years old.
But in 1974, the 10-year Treasury went up 6.76% to 8.3%. So it went up a little bit. Okay. Inflation in December of 1974 peaked out at 12.34%, which is insane. We're at 8.6% now, and in 74 it hit 12.34%.
My recollection of 1974, I remember going to California and sitting in our car in a gas line waiting to fill up our gas tank. There was lines of
People trying to
fill up their gas tanks. Yeah.
Crazy period, and a bear market was happening and a recession, which is similar to now. But here's the interesting thing that I noticed of 1974, and people at home, just take note of this, because this is what I wanted to hit on today. In December of 74, that's when inflation hit its peak at 12.34. The market bottom occurred that same time. So peak inflation in 74, market bottom. As soon as inflation started to fall, the market started to rally, and a new bull market began. Okay, that's 1974. 1980, which was a quick recession, not a horrible one, but the 10-year went from 10.5 to just a little over 13%. So a 3% rise in the 10-year. Okay, inflation peaked, and this is crazy, in 1980. I was born.
Mm-hmm.
I remember as a toddler. No, I'm kidding. Peaked out at 14.76%. That's your inflation. In April of 1980. Guess when the market bottomed.
Soon. Right about that.
April
Yeah.
of 1980. Same exact time you saw peak inflation, you saw a market bottom, and then a new bull market occurred. So very similar in that way. Okay, so it's two times where you see peak inflation and a market bottom. Is that coincidence? I don't know. Let's look at 2000, or not 2000. Let's look at October of 1990. Okay. 10-year went from 8.4 to 9, so not a huge bump in the 10-year, but still a lot higher rates than they are now.
This is 1990.
1990.
So 1990, I was just brand new in this business.
Yep.
And it's hard to believe that we had interest rates that high back then. It's
9%.
we
And you know what? The period that early 90s, it barely budged at all. That 10-year, it floated, 8.5 to 9 to 7, but in that range, 7% was the lowest, from 90 to 92.
I remember selling government or tax-free bonds at 7%.
That would be a good deal.
7% yield.
We would
tax-free.
actually like
yeah.
bonds in that scenario.
Right.
Okay, but not to get off track. October of 1990, inflation peaked at 6.29%. Okay, guess when the market bottomed?
About that same time.
October of 1990. And so you have three instances where there's rising rates, there's high inflation, and whenever we saw that peak inflation, we saw the market bottom. The market is crazy at pricing in what's happening in the future.
The market's always looking forward. It's pretty good at that.
Yep.
The market is always looking out 6 months, a year and a half into the future, and I think that's why.
That's why you see a top of inflation and a bottom of the market.
Mm-hmm.
So what's the good news about that? Well, the good news is we kind of we got to keep our eye on inflation, right? Because assuming that the future's similar to the past, we could see inflation peak and a market bottom. That's the good news.
The question is, have we seen peak inflation?
That's the question.
It's debated right now.
With gas continuing to go higher, which is a huge part of that inflation number, I don't think it has. I think we'll see inflation tick a little bit higher, which is bad news on two fronts, right? And I could be dead wrong. I've been wrong before plenty of times. But that would mean that we have more downside to go.
Right. I saw an interview. This is probably about a month ago from a bond expert guy. He's pretty famous in financial circles. And he believes that we're near peak inflation. This was a month ago. I heard him actually yesterday in an interview. But it doesn't mean that inflation is just going to turn around and start coming down quickly. He doesn't believe that, but he thinks that we're kind of hitting that crest, and that inflation will start to slowly come back down. But that's nobody knows.
Yeah, nobody knows. In those times where inflation peaked, 74 it kind of collapsed. Well, in 80 it did too. October 90 just kind of went sideways for a little bit, came down a little slowly. But the markets rallied hard all three times.
Yeah.
So what are we doing about it? If that's what we think is going to happen, what are we doing about it, right? We're sticking to our process, buying great companies at good prices, and I'm selling a whole crap load of options right now, right, to make short-term income on the volatility that we're experiencing. So that's what we're doing about it. Okay? But let's continue to look at history to figure out if we should just sell outright if we think the market's going lower. I mean, I don't know, but should we sell outright? Here's what history says, okay? This is the history of bear markets and bull markets since 1942. The average bear market period lasted 11.3 months. Hey, how many months are we into this?
It's about 6.
6?
5 or 6?
Yeah, I'd go 7.
Okay.
Okay, so we're 7 months in.
Going once?
Going once, going twice. Just because I feel like in December, I'm factoring in the month of December.
Okay.
And so I'm adding a month into last year.
Okay.
Is that okay?
I'll give you that.
All right, okay. So we're 7 months in. The average loss, meaning drawdown, of the S&P 500 was 32%. Okay. We're down, what did I say? 20 almost 23% now.
Yeah.
So what does that tell you? I mean, if these averages, which averages are always off.
Averages are never average.
Perfect.
Well,
yeah.
we always talk about averages, but in any one year, the average, that year is never average. It's it's always above or minus, and then down the middle is where you get the average. And so it could be higher, lower than that number. Maybe we're bottoming now at 20%. Maybe it's a little bit more than.
Yeah.
But maybe it's close to that average, that 30% down.
But if that's the average, then we're almost there.
Yeah,
if we hit that average.
We're 2/3 there, 60, 70%.
So what
there.
would your advice to people be if should I go into cash or should I stay invested? Based on all these numbers, if we don't believe inflation's peaked and we think the market might come down a little bit more, what would you say?
Well, so it's a good question, and we get that. I think we kind of get that. Most of our clients know, they know how we invest, and so I don't actually get that question a lot, but I think some people think about it.
Yeah.
And I think about it all the time. Say, here we are. If we think the market's going to go down another 10%,
which I have no idea.
Well, no,
for the record.
But that's why.
Yeah.
That's why we don't. That's why we don't, because we don't know whether the market will go down another 10%. I mean, it's possible, but here's the flip side of that. I believe that a high probability 3 years, 5 years from now, the market will be higher. So yes, we might have. Are you willing to accept some more short-term pain with the possibility or the high probability that 3 and 5 years from now your accounts will be, significantly higher than what they are today?
Okay.
So to me, that's how I frame it.
Yep.
I'm looking out. I think it's hard to know what's going to happen. In fact, it's impossible to know what's going to happen in the short term. What's going to happen tomorrow? In fact, I went to bed last night not knowing what the market's going to do today. I suspected it would be down just because it was up yesterday. It just seems like that's the pattern right now. And every time we have an up day, we have a down. Yeah, we have a down day. And every time we have a down day, actually we've had more down days, but occasionally we'll have an update. That's where we are right now, is in a bear market. I had a client the other day send me a text, and he said. With the current environment, we have a new strategy. And I says, well, to myself, I said, well, our strategy is to buy great businesses and make money over the long term. Are we changing that strategy? No, we're not. We own great businesses that can survive during the difficult economic times.
And Warren Buffett is probably the best at this strategy ever. We think he's the best investor we've ever seen ever.
Well, I think it's. I mean, it could be debatable, but there's no question he's one of the greatest investors of our time. And I have a great quote. During the financial crisis, Buffett wrote an article in the he wrote an op-ed article in the New York Times called "Buy American IM," and and this is in October of 2008. This was right in the middle of everything. The world was falling apart.
Market was down 50%.
And he was buying. And he basically said that, our economy's in a mess, the market's down, but I'm buying. Let me just read this paragraph. And he talked about, why am I buying stocks today? And he said, a simple rule dictates my buying. Be fearful when others are greedy, and greedy when others are fearful. And most certainly, fear is now widespread, gripping even the seasoned investors.
Hold on real quick. That's exactly where we are right now.
Exactly.
Tons of fear. Not just because of the market, but across a lot more than just the market. So what else does he say?
Yeah, I think I think you're right. Everybody is fearful. Even the most seasoned investors there's a lot of uncertainty.
Yep.
And right now.
Yep.
To be sure, investors are right to be wary of the highly leveraged entities or businesses in weak competitive positions.
Whoa, hey. That's exactly what happened this time too. All of last year, we're doing these podcasts about companies that their valuations just don't make sense. And there's Bitcoin and SPACs and That's all leveraged up the wazoo.
So
Very similar.
if you owned those businesses that were highly leveraged or weak competitive positions,
You're down 70, 80%.
you're down big time, and you should be fearful. He says, but fears regarding the long-term prosperity of the nation's many sound companies make no sense. These businesses will indeed suffer earnings hiccups, as they always have, but most major companies will be setting new profit records 5, 10, and 20 years from now. So I went through the financial crisis. I know what that was like. I know what it was like to manage other people's money during that time.
Yeah.
That experience, and also the .com, and I've been doing this for 30 some years. That's why we own businesses with long-term competitive advantages. We talk about owning businesses with a wide moat or a competitive advantage. That's why we have the process, the philosophy that we do, so that we can go through these periods of time and look forward 5 and 10, 15, 20 years from now, and have high confidence that our business will be making record profits, and with those record profits, record valuations.
Yep. And so here's where the good news comes in, because I haven't been really sharing good news so far, right?
No,
here's the good news as it relates to what you just read. After a bear market occurs, a new bull market starts. And the average bull market since 1942 lasts 4.4 years with an average return of 155%. That's what he's talking about right there.
Yeah.
That's how you compound your money. Right? You can't time the market perfectly. We're almost through the bear market. I don't know how long it's going to last, but if we're down 22% and the average is 30%, we're almost there. So patience, you own great businesses, and look forward to the new bull market that's right around the corner.
Yeah, I mean, you can't keep the economic engine of America down for very long. I mean, during the financial crisis, our economy suffered. We had a weak banking system. We went into that financial crisis actually in not very good shape, and we survived it. With a weak banking system, we survived it. And today, to kind of paint a positive light to our current situation, we have a really strong banking system. We have strong corporations. We have strong consumers. We have low unemployment. We have a lot of good things, a lot better than when we went into the financial crisis. Now, what we're dealing with today is something different, and that's inflation.
So, can I read this other Buffett?
Go ahead.
Okay. This one. Right here. Inflation. This is what he said about inflation. And he marks some periods of time and talks about World War II. But he said, again, in the 1980s, okay, and I'm just going to insert in the 2020s, the time to buy stocks was when inflation raged and the economy was in the tank. Inflation is raging right now. Yeah. Warren Buffett's saying that's the time to buy stocks. Everybody's fearful. So now's not the time to sell. Now's the time to actually put more money to work if you got it.
Yeah.
That's what he's saying here.
Well, and if you look at what he's been doing, what Buffett's been doing, so he's at the end of 2021, Berkshire had I think it was right around $150 billion in cash. They have less than $100 billion now. He's invested over $50 billion in Berkshire Hathaway. He's bought back Berkshire Hathaway stock at prices much higher than today. So, and he's always said, I will never buy Berkshire stock unless I think it's selling below fair value, below intrinsic value. So he believes the company at higher prices than today was selling below fair value. He's been putting money into another insurance company. He's been putting money into Chevron and money into Occidental. Yeah. So he's putting money to work. And I suspect we talked about this a minute ago, when 13Fs come out, when we find out what other money managers, where they're putting their money, I suspect Buffett's has been buying more and more this last quarter. So, he is doing what he said he would do during the financial crisis. He's putting money to work. I think that's the right thing to do. there's probably more pain ahead of us in the next, who knows how long, but
Hope not,
but
maybe.
but there probably is.
Yeah.
I'm kind of just expecting it will, and if we start peaking out inflation and the market starts stabilizing.
That's what we're looking at, right?
That's what we're looking
That's
at.
what history tells us.
Yep, and I watched the 10-year Treasury. I watched that because that's a good indication of where inflation's going, where the financial markets thinks inflation's going.
So here's an exercise that I would love to give everybody at home, an assignment. Okay, take your birth year and look at the price of the S&P 500. And then I want you to write down all the crazy things that have happened since your birth year, right? 1977 for me. How much has gone wrong since 1977? I mean, a lot. Some would say my birth. It's maybe some clients right now.
77 was a terrible year.
Yeah, brutal year. If you would have taken $10,000 and invested it in 1977, do you know how much you'd have now?
A lot.
$364,000.
Yeah.
It's a long game. It's not a 6-month, 8-month, 11-month game. It's a 5, 10, 15, 20-year game.
And I think that's, as I was walking into the office today, I thinking about what we're going to talk about today, that's exactly what I was thinking. It's kind of, to have success investing, you have to have a certain mindset about what investing is. And what you just said was exactly how you have to think. It's the long game. It's 3 years, 5 years, 10 years further down the road. It's not 3 months, 3 days, 6 months. It's the long game. And I just read Benjamin Franklin's book. It's on my desk.
Yeah, great book.
You told me, hey, that's a great book.
Yeah.
What's
his book about money?
Yeah, The Way to Wealth, I think.
Yeah.
Yeah. And he talks about Poor Richard, and Franklin was a brilliant, wise guy. Brilliant, very smart man. And anyway, just be wise about your money. That's what his book talks about. Is just be wise and think. When it comes to investing, you need to think long term, not 3 months, not 6 months, but 3 years, 5 years, 10 years.
Yep, and do, as we've talked about oftentimes on this podcast, when it comes to money, do the opposite of what you're feeling.
Yeah.
Right?
It's natural to feel especially when we talk about, hey, the market could go down another 10%. Could go down another, maybe another 20. I don't know. I'm not saying that's going to happen, but it could. So you'd think, well, if you think that could happen, why wouldn't you sell?
Because it can turn on a dime.
Right. Yeah, you just can't predict it.
I hope that helps everybody at home to understand what's happened in history, in rising rate, high inflationary periods, most times marked by recession, and then what has happened afterwards. And a great bull market's on the other side of this. We just got to get through it.
And then the only thing I would add, Brett, is anytime you get nervous about your portfolio or investments, look at the companies you own and ask yourself, is this company going to be here 3, 5, 10 years from now? Is it going to be more valuable 3 or 5 and 10 years from now? And I think I'd say 100% of the companies we own, I think you'll say that.
Yep.
I say that.
That's another good exercise to go through.
The market, if the market were to shut down, this is how I think about it. If the market were to shut down for the next 10 years, and I knew that at the end of today, is there any stocks in my portfolio that I would not want to own for the next 10 years? And the answer to that for me is no. I would be comfortable owning these businesses for the next 10 years, and I couldn't sell a single one of them. I would be comfortable with that.
I'd be comfortable holding the stocks. I'd be screwed with options because they'd all expire.
Yeah.
Glad that's not going to happen. All right, my friends. Stay the course. Any questions, let us know. Thanks.